Welcome to The Explainer. If you love cutting through the noise and getting straight to the core of complex business movements, you are in the exact right place. Today, we're taking a deep, focused dive into the Q2 2026 earnings of Integra LifeSciences. We're going to look way past the surface-level numbers and break down exactly how this medical technology company is navigating an operational turnaround, managing some global macroeconomic headwinds, and ultimately setting the stage for future growth.
Okay, let's quickly look at our roadmap for today. First, we'll hit the Q2 big picture. Second, we're diving into the segments. Third, we'll look at the cash and balance sheet. And fourth, we'll wrap up with the full-year outlook. Let's get right into it.
Starting off with Section 1, the Q2 big picture. When a company is in the middle of a strategic pivot, top-line revenue is absolutely your North Star. And here is that indicator, $419 million. It's a massive reported revenue number for the quarter. And frankly, the context here is what makes it so important. Not only did this figure beat the top end of their own guidance, but it also represents a very healthy $27 million sequential increase. You can literally see the momentum building here.
Now, numbers like that, they don't just happen by accident. This strong quarter was entirely enabled by solid execution and predictable performance, tying directly back to their 2026 priorities. Integra's management team has been laser-focused on creating a much more predictable cadence, really smoothing out the operational bumps that tend to distract from pure growth.
So the crucial point is how they actually achieved that predictable performance. It all comes down to these four strategic imperatives. They've been relentlessly focusing on driving supply chain reliability, accelerating growth, igniting innovation, and delivering best-in-class quality. And these aren't just corporate buzzwords, right? These four pillars acted as the direct resolution to the broader operational and supply challenges they were facing. By stabilizing the supply chain, they finally unlocked the ability to meet the demand that was basically just sitting there waiting for them. As we look at how that revenue translated into growth, it's pretty vital to understand the difference between reported and organic metrics. Reported growth came in at 0.8%, while organic growth was 0.7%. So why the slight gap? Well, organic growth strips out the effects of external factors, most notably currency exchange rates. So while the raw dollar amount hitting the books grew by 0.8%, the core currency-neutral business expansion was a very steady 0.7%.
But hey, revenue growth only tells half the story. We always have to ask, so what? How does this actually impact profitability? Take a look at these margins. Adjusted gross margin hit 61.3%. That's a 60 basis point jump. Adjusted EBITDA margin leaps to 18.7%, up a full 160 basis points. And adjusted EPS landed at 56 cents. That 60 basis point bump in gross margin wasn't just a lucky break either. It was directly driven by highly specific margin improvement initiatives, internal efficiencies, and a really favorable product mix. Bottom line, they are keeping more of every single dollar they make.
Moving on to Section 2, diving into the segments.
Now, what's really interesting here is the clear contrast in operations between the two halves of the company. Specialty surgery brought in the lion's share at $309.3 million, posting low single-digit growth of 1.7%. Meanwhile, tissue reconstruction brought in $109.5 million, but actually saw a slight decline of 1.9%. Let's unpack exactly what is happening inside each of these divisions.
Zooming in on specialty surgery, we can see exactly how they hit that $309.3 million. A massive 69% of this revenue comes straight from neurosurgery. This segment is being propelled by continued, incredibly strong demand for core products like Certas Plus, CUSA, and Bactiseal. When the demand for your flagship neuro instruments is this robust, it just provides a tremendous foundation for the entire company.
And this brilliantly illustrates where the money comes from over in the tissue reconstruction segment. Wound reconstruction solutions totally dominates the composition here at 74.3%. The underlying story here is actually quite positive, driven by really strong growth in their DuraSorb product line and the highly successful relaunch of PriMatrix.
But wait, if DuraSorb and PriMatrix are doing so great, why did the segment shrink by 1.9% overall? Well, the vital context here is a comp issue. Think of it like comparing your normal weekly sales to the week you ran a massive inventory clearance event. Back in Q2 of 2025, they had a huge clearance of back orders for their Integra Skin product, which temporarily spiked last year's revenue. So they were essentially comparing this quarter to an artificially inflated quarter from the previous year. It's not a fundamental flaw in the product line, it's simply the math of year-over-year comparisons normalizing.
All right, shifting gears to Section 3, Cash and Balance Sheet.
When we examine their underlying financial foundation, things are crystal clear. They're sitting on $214 million in cash and cash equivalents. And yes, while they do carry $1.6 billion in net debt, the real standout figure is their total available liquidity. $496 million. That is nearly $500 million at their disposal. It provides a highly solid foundation to navigate market fluctuations while continuing to invest in those strategic imperatives.
You've also got to check out this number, $35 million. That is a seriously impressive improvement in their first half 2026 operating cash flow compared to the prior year. They are generating cash much more efficiently right now, which is also reflected in their 24% adjusted free cash flow conversion rate. Cash generation is confidently moving in the right direction.
Let's move on and see how this builds into Section 4, the full-year outlook. So, with half the year in the books, how is management projecting the company's trajectory for the rest of 2026? Well, they are reaffirming their core guidance, which sends a very strong signal of internal confidence. They project full-year reported revenue to land between $1.65 billion and $1.70 billion. Adjusted EPS is locked in between $2.40 and $2.50. And crucially, they expect full-year adjusted EBITDA to improve by 100 basis points, a full 1% compared to 2025. Basically, they're demonstrating confidence that those supply chain improvements and cost-out initiatives are going to stick around and deliver value for the rest of the year.
Of course, no global business operates in a vacuum, right? There are always macroeconomic hurdles. Their guidance actually bakes in the impact of global trade policies. They're assuming Section 102 tariffs apply through July, with Section 301 tariffs taking over for the balance of the year, which effectively applies a 14% tariff on U.S. exports to China. That translates to a roughly 10-cent hit to their full-year adjusted EPS. However, it's worth noting the company plans to offset these hits through internal tariff favorability and potential debt refinancing actions in the second half. It's a very pragmatic, mathematical approach to global trade dynamics. Now, looking toward catalysts for the back half of the year, this is a massive one. Their Braintree facility is now officially online and actively producing inventory. This is all gearing up to support the planned Q4 relaunch of SurgiMend. This ties straight back to their strategic imperative of igniting innovation, and it serves as a major potential growth driver as we close out 2026.
Which leaves us with this final provocative question to consider. With supply chain reliability visibly improving, margins expanding, and a major catalyst sitting in Q4 with the SurgiMend relaunch, can Integra LifeSciences maintain this momentum and carry it into 2027? The foundational pieces certainly seem to be falling right into place. Thank you so much for joining me for this explainer. Keep this company on your radar, and I look forward to breaking down the next set of numbers with you soon.